Hello and welcome to the Property Trio, as Dave says, the podcast for the sophisticated property investor. It's my pleasure to be hosting today, and we've got a listener questions episode coming your way with two really cool questions. Challenge for us is to complete our answers for these two questions in a segment that's less than an hour this time. We've had a lot of fun with the last couple of eps, but we know we've gone a bit over. Anyway, it's good to see you too. How are you, Dave and Mike?
G'day.
Good, well. Thanks. Good morning.
Yeah, good morning. Well, let's get straight into this. We've got a fantastic question from Matthew. I hope this message finds you well. Love your podcast. I'm currently seeking to purchase an investment property in Melbourne. Woohoo! My maximum budget is 1.2 million, as advised by my mortgage broker, and I'd appreciate your opinion on what you consider to be the optimal investment grade asset. So Matthew has a couple of options in mind, guys, but before I go into that, I want to chat about his budget. It's within the bell curve of investor budgets that I deal with. So when I look at the ABS stats and also the ATO collation of information about what investors typically spend, it tends to be a lower number than what I deal with. Now, that's not a surprise. Maybe people with higher budgets are a bit more fearful about making sure they're getting the right advice and picking the right property, and they come to an advocate. I think there's every chance that that's a possibility. So while it's in the heart of my bell curve, I want to ask you both the same question because you're each very much privy to what people are spending. So what price points have you seen investors reach to over the past couple of years, Dave?
Yeah, look, I had my own sort of estimates and we don't track it as closely as we should. And I also asked our brokers what they thought the numbers were for them. So, basically where that's landed is, look, the general range would be between 500K and 2 million. Yeah. I'd say the bell curve and talking to the brokers sit somewhere in, say, the 700 to 1.5. And then what one of the brokers called the sweet spot, he has around 900 to 1.2 million, where most people sort of our clients who are, Melbourne based, are looking to purchase. It doesn't always mean all these clients are purchasing in Melbourne. Some of them might end up purchasing in a Geelong or a Ballarat or similar, maybe down on the peninsula. But that's probably the range. We also just, we have about a third of our clients who are Sydney based. So just for, I guess, some extra context there, I'd say the bell curve for our Sydney clients is more like 1 million to 1.6, with stretch purchases above 2 million. And probably the last thing I'd add is that often those higher end ones are potentially future homes that are purchased as an investment property initially. Occasionally, they're a holiday house that doubles as an Airbnb, and even less occasionally, but I do see it happen, it might be a couple purchasing an investment property, but it's also for one of the couple's parents, or maybe there's only one of the parents left to actually live in and rent out of as they downsize the family home as well.
I love it. You've touched on a few things that we're going to drill right into in a few minutes. Mike, you get a very specific overview for investor spend, and it's been intriguing. I know I've enjoyed going through your data with you that you've collated in your 1,000 asset studies. What are you finding people are spending?
650K is the
that's the number.
Short answer. Yeah.
So you're aligned with the ATO, and Dave and I have that fantastic bias story to talk about.
Yeah, well, I mean, when the question was, what are you seeing people stretch to? I mean, I'm seeing people stretch into the sort of 8-figure band, but as Dave says, often there's a dual purpose reason for that. It's something that they're intending to live in, and in fact, in our own data, between 22 and 25% of investor purchases come to us having previously been their principal place of residence. So it's a huge amount. So, when we we sort of solve for removing that, the price can come down. And when we remove the statistical outliers using GPT's models, the figure actually drops to 550K. Now, that's probably a 2024 story of many of the regions. Like our most invested region of 2024 for our clients is the Townsville statistical area 3, and that market has moved a lot. You used to be able to get things in the 400s, but that's long gone. But yeah, it is around that sort of 650K mark for on average for our database.
Yeah, that's interesting, and well, not surprising, because you're getting a broad cross section of buyers, and everyone is interested in optimizing their tax deductions when they know it's on the table. So
I mean, it would be interesting because that's obviously for the whole of Australia. It would be interesting to see your numbers, Mike, for say capital cities and the regional areas of a state, or just major regional areas at some point, just to see how those differ.
I can make that dream come true for you, Dave.
Yes. That's a little sneak peek into an upcoming episode. All right, well, let's get back to price points and investors' appetites for certain price points. They vary on many things. I made a bit of a list, but capital growth versus a cash flow strategy, that's a big determinant of what sort of price point you'll set, because obviously the two are quite different. Mike, I'll get you to explain that for the layperson.
Yeah, well, when it comes to strategy, we often sort of hear this dichotomy of it's either cash flow or it's capital growth. And I always picture that little Mexican lady with the little girl with the tacos, with the why not both? Because that's the golden standard. And, you hear people say you can have both. And then you hear people saying if people promise you both, then they're lying through their teeth. But at the end of the day, it's a balance between an asset that is going to grow its net value, and then you've got an asset that is going to outperform, let's say, something that is purely a growth asset from a cash flow point of view. And I don't think anyone should be enamored with either approach, because it all comes down to what is actually a requirement for you to build the portfolio. If you're on a huge salary, you don't necessarily need to worry too much about cash flow until you get to a certain point. You can certainly get stuck if you're getting a pool of negatively geared assets, but cash flow is important, because if you're trying to continue to grow that portfolio, the bank at some point is sort of going to go, look, you're on 100 grand. It's costing you $400 a week to hold this portfolio. We don't want you to buy any more of this sort of stuff. But it does really depend where you're at. Are you at the sort of beginning? Are you at the end? Are you trying to retire your debt and live on the cash flow? But there's a number of ways to look at it. But I think it really has to align with your strategy and where you are in your investing journey.
I love that. I agree with every single point you've raised. And your debt retirement strategy is a big one, because if you can carry that cash flow, the negative cash flow, but you have a plan in mind to sell up one of your properties and get rid of all of the debt at one stage, then you'll get a better performance overall. But if you're planning on holding every single property and you're nearing retirement, well, you might look at things differently. So I think all of those metrics have been great for you to overview, Mike.
I don't think cash flow necessarily makes you rich with residential property. It is really the growth that does that. That's what grows your net wealth. But
it's the largest portion, isn't it?
Yeah, but the cash flow needs to be there to support your capacity and your lending.
And it's at the most critical point at the beginning of the journey. That's when it's at its widest, unless something goes a bit pear-shaped with your tenant demand. I think that people need to really bear that in mind. What is your end game? And I've ran some numbers recently when I was comparing two scenarios, and we've talked about this before on the show. When you've got a capital growth asset, you've got to remember that while your yield might be horrible at the start, your rental growth rate is going to be higher than what your yielding property will be.
That's right.
The yielding
because
property
it tends to keep pace with the capital growth of the property, the growth in rent, and that's very different to the yield itself, which might be lower than
Yes.
a lower valued property.
Yeah. So the difference is you'll have an easier chance at borrowing that money for the yielding property at the start, but long term it won't reward you like the capital growth property would have in both capital growth and rental growth.
That's right. And as we've touched on before as well, your rental income isn't very rewarding itself from a borrowing capacity perspective, because the banks chip into it so much and take so much away from it that it really makes it quite negligible in terms of how much it helps your actual borrowing capacity. Obviously, that's relative to how many properties you own and how much rent you end up accumulating over many properties, but one property itself, particularly at a lower value, tends not to make much of a difference.
It's
Good point, Joe.
pretty crap, isn't it? I mean, like, so you often hear that the banks will take 80% of the rent. What happens to the other 20%? Are they saying that that's vacancy, or is that repairs and maintenance? Like, really, these macro-prudential policies should be floating targets. You know, we've talked about the serviceability buffer of 3%. I mean, that's appropriate in a market of appreciating interest rates, right? Because you're always kind of wanting to be a little bit ahead. Now, you know, the only way is kind of down. It requires a bit of a rethink. That was kind of brought in to slow the growth of interest-only loans for investors and things like that. But it just kind of sticks. I mean, if I was made treasurer or emperor or something terrifying like that, that'd be one of the first things I'd do.
I love that, Mike, but we've got to remember that it's quite different now to what it was, 5 years or even a decade or two ago in terms of rental vacancies and the pace of rents. We were dealing with much higher vacancies and stagnant rents for a long time. So I understand that the bank's being a little nervous about that, but I do think it's time to reconsider that, because I remember back in my early broking days, we'd take 100% of rents for investment properties when looking at servicing calculators.
Certain lenders would, yeah.
Good old days.
They were much
Good old
friendlier.
days.
And, you know, there's still some non-bank lenders who are much friendlier as well, but they charge us slightly higher rates.
Yeah. Now, Dave, I want to circle back to future family home versus pure investment, because investor price appetites can be really influenced by this. If they know that they might be living in it one day, they'll absolutely spend more.
Yeah, exactly. So when people, as I just touched on before, when people are looking to purchase a stepping stone home, but potentially it's out of their reach to live in it right away, and that might mean they keep living with mum and dad for a little longer, or paying, you know, living in something somewhat of a dive and paying less rent to set themselves up to be able to move into that home. Well, then often they'll stretch themselves, but it will start as an investment property. And then when they feel like they're financially ready, which I find because of that motivation, that they've actually purchased the property and it's sitting there and they just can't touch it, so to speak, and move into it. The motivation means they often end up moving into it within 1 to 2 years, I find, from our experience. So, but if they're looking at investment strategy and haven't purchased the home yet, well, then that tends to really limit their investment purchase price range, because obviously the more they spend, the bigger risk that either they're going to have to sell that investment property or properties, or it's going to take them longer to get into the family home, or they'll have a much smaller budget for the family home. Yes. So, you know, obviously if you haven't purchased the future home yet, and you're not purchasing a stepping stone home that starts as an investment, then that's really going to hit your investment budget. Whereas if you do have that long-term home, you know, in the jar, the big rock in the jar, as we call it, well, then, you know, you're free to invest and just follow your pathway towards your retirement goals and whatever they may be. And then it comes back to those fundamentals of, okay, well, how does it align with your retirement goals, your risk profile, your stage of life? You know, how many properties would you, someone who just is happy to own 1, 2, or 3, or you really want to accumulate a large portfolio? Then you can, you know, really focus in on your investment strategy because the home's locked away.
Yeah, I love it. So we've talked about the things that can influence people's investment budgets, and they're all of the strategy related things. Then the other two obvious ones, in my view, are interest rates and equity growth. Because we don't tend to deal with a lot of rent investors, and you've talked about the risks of that today and on other shows, Dave. But when people don't have that equity growth, they're pretty limited to being able to do something. So they're the two environmental factors that can influence how much someone will spend. Now, circling back to Matthew's question, he came up with two options. Option one, a single fronted 2-bedroom cottage in the inner northern suburbs. He's nominated a few: Coburg, Preston, Pascoe Vale, anyone that knows Melbourne. They're all in that circa 10 kilometres north of the city band. And when he mentions a single fronted 2-bedroom cottage, generally they're little Victorians, and they've got the hallway down one side and bedrooms off to the other. The challenge that we've got is Coburg, Preston and Pascoe Vale do have a few of these, but they're not inundated. The challenge is that these types of products were turn of the century. They're all circa 1880 to 1910 builds. And you've then got to look at when a city was subdivided and how it grew and when it grew. So as you get into the upper parts of Coburg, Preston and Pascoe Vale, you're then dealing with Californian bungalows and the next era of housing. So that's one challenge for Matthew. Can be done. And 1.2 would get you something good. I'd say Coburg is his likely area for that product. Option two, though, is a 3 to 4 bedroom freestanding home in the Bayside suburbs of Cheltenham, Chelsea, etc. We're getting into the city of Kingston there. 1.2, in my view, won't get you a lot in those locations. I think you'll need to go a little bit further to get that freestanding family-sized home. He's also open to any other suburb recommendations for suburbs at a $1.2 million price point. So this is interesting because Matthew's come to us with a few ideas in mind. But Dave, I want to ask you, can you explain what sort of information we'd ordinarily want to source from someone when they're asking us this kind of question?
Well, look, at some of the things we've already touched on, but it's understanding, obviously, their current cash flow, what they'd like. Well, firstly, it'd be narrowing in to make sure the price point's right for them. Now, how you do that is obviously your own personal cash flow goals for now, because once you settle on the property, you really want to narrow in and go, okay, well, today you're saving, call it $4,000 a month. After you purchase this property, how much do you want to have in the bank each month that you're saving? How much of a buffer do you want to be comfortable with? That ultimately, that differential. So let's say you say, well, we're happy to go down to $2,000 a month saving as a bit of a safety net.
Yep.
Well, really that $2,000 differential is what you can put towards the property on a monthly basis. So that is, that should be a starting point. That's one of the starting points would be the sanity check. Is 1.2 million the right price from your cash flow preferences and goals perspective? So that would be step one. And let's say that's it. Then you also need to obviously make sure you're going to get a loan approved for that level, because just because you think you can afford it doesn't mean a bank will lend you the money. So that would be the next step. If we're just narrowing in on, the price point and the property strategy and not bigger or broader pictures, which I won't go into, then, okay, well, how does that align with your retirement goals? So what are your retirement goals for property? How far, are you towards them? And then that comes back to those points of stage in life. Is this the only property you're buying between now and retirement? Do other properties have to fit into the picture? Those types of questions. Then, we can start to boil down to potential suburb recommendations. And obviously, that's where particularly the specificity of that, you talk to a top-end buyer's agent and to really get into some specifics. Our property planners can talk to them about different locations. You might go, okay, well, here you haven't mentioned sort of middle or outer middle eastern suburbs.
Yep.
Here's some options out there. And then, it starts to look at personal preferences, what are the yield returns, etc., and marrying that up with the particular buyer, which obviously getting to the granular, a property planner can talk on a mid level, and then a
Yes.
buyer's agent can get down into the granular. But then you've also got great buyer's agents like you who can talk to that granular around the whole city. But then you've got other buyer's agents who really just, can talk to their patch. So you're going to be steered towards where they buy and where they prefer to buy. And that can be a benefit of working with an independent property planner, who doesn't have buyer's agents in house, so that you have a broader brush perspective before then talking to buyer's agents and narrowing in even tighter with your selected buyer's agent.
Yeah, no, great suggestion. Mike, while we're chatting about the challenges, because Matthew, we do have some ideas for you, can you shed light on what you think some of Matthew's other challenges might be with this brief?
Well, one of the challenges is that Melbourne is busy. We were just talking off air about you chatting to some of your industry colleagues, and everything's kind of flat out at the moment. So it's not like buying in Melbourne 12 months ago where there wasn't the same sort of competition. I think there's a lot of people that have invested very heavily in the mean reversion theory, which is an upcoming episode. I think we're going to nerd out on that. So that's going to be a bit of a challenge. Also, I want to take
Do you think most investors know what mean reversion means?
You'd like to think so, but after they listen to our episode, they'll be able to give a lecture on it, I'm sure. I want to take a little bit of a step back as well, where it's kind of like max budget of 1.2 as advised by my mortgage broker. And he goes on to say, also open to any other suburbs at the 1.2 price point. Just because you can borrow 1.2 doesn't necessarily mean that you should. I get it. It's like a bank wants to give me money. Well, quick, take it before they change their mind. But some of those Coburg style Victorian properties, they're going to be very, very low yielding, I would assume. So that is a little bit of a challenge. And we don't really know what the rest of his portfolio looks like, what his salary is. And Dave's kind of elucidated a few issues to how he can't give, very specific advice. But if you take the point that he sort of finishes on is that his goal is to achieve highest capital growth over the next 5 to 10 years, allowing me to leapfrog into my property. I mean, 5 to 10 years of that sort of property could, he could get really tired of that negative cash flow position. And if it's all about maximizing equity as sort of quickly as possible, I mean, there could be opportunities to take some of that budget and look for something that has some upside potential, something that is not necessarily sitting at its highest and best use. And that might just be a property that requires some alterations or some renovations. Obviously, it's kind of tricky in the climate we are in with a shortage of builders and those sorts of things. But those are the things that kind of stick out to me, Cate.
Yeah, good call. Matthew also notes, I'm not interested in strata assets. It has to be Torrens title and renovated. My primary goal is to achieve the highest capital growth, as you said, Mike. So let's chat about his desire not to buy into a strata asset.
I get it.
Some of the reasons that investors like to avoid strata is the perceived lack of control. There's also a perception that strata fees equate to higher running costs, and this can be a bit of a furphy because a well-run strata covers maintenance and insurance. And if it's doing that really well, you could be getting a scale of economy. So I always say to people, don't write a strata property off because of that theory without checking through the financials and the minutes and having a chat to the owner's court manager or the strata manager, because you might be buying into something that's really well run and, individually the sum of running them would be even higher. There's also a train of thought that townhouses underperform. But is this always true? And I just want to plant this thought. If I could select a great townhouse in a blue chip suburb and compare it to a freestanding house in a different suburb, for sure you might be able to find a house that outperforms, but I'm pretty confident I could pick a townhouse that would outperform an average freestanding house in a different suburb. So there are townhouses and there are townhouses. it's how you go about dissecting how it's run, where it is, what the layout and the setup is, orientation, privacy, all of those things. There's also some of the reasons why investors avoid them is lack of subdivision or build option and negativity about shared walls. Okay, I get it. And fear of new build quality. And I definitely get that as well. But I think if we're talking about Matthew getting started and he's decided on the Melbourne market, Dave, what are the next steps that you think he needs to do to get the assignment off the ground in the best way possible?
Well, probably alluded to it to some degree already, but I would always recommend first start with a property plan.
Yeah.
So get your ducks in a row, understand how this property fits into your bigger picture, aligns with your retirement goals, any other properties you plan to purchase, your cash flow, etc. So, I think you also need to meet and be working with a strategic mortgage broker who is ensuring that your mortgage strategy is right, you're optimizing your tax deductions, everything, your money management system set up properly, you're considering ways to manage your risk through your mortgage strategy. And then the other piece of the puzzle, primary piece of the puzzle, is a buyer's agent. Make sure you're working with the right buyer's agent who can help you narrow in on the right suburban asset type to align with your property plan and your what you can afford, your price point.
Nicely done. Mike, what's your tip for Matthew?
I'm just also thinking, with the time horizon of 5 to 10 years, which is good, we also kind of need to think about the demographics of the property. So say, for example, if we're looking at one of those 2-bedroom sort of cottages in Coburg, who's going to be in the market to buy that in 5 or 10 years, and at what price point? I mean, there's an argument to say that that's probably going to be out of reach if it has the capital growth that he hopes for first home buyers or, people that are trying to get their foot in the market. It's not necessarily going to suit downsizers, particularly because we did an episode about that recently where they actually do kind of want a little bit of space for hosting Christmas and kids and those sorts of things. But I'd have to echo Dave's sentiments. And it really comes down to the fact, okay, well, if you're holding this for 5 or 10 years, you need to be comfortable with the negative position of it, because either way that you go, it's going to be negatively geared for quite a period of time. So it really all comes down to making sure that you've got that strategy dialed in, because the number one thing to avoid is being forced into a position where you have to sell that property, because nobody wins on the buying and the selling. That's where you get all of those costs. So without that strategy and being clear on the buffers, I would hate for him to get into trouble.
Okay.
Kate, just a quick one for you. If you're talking to him about locations and
Yeah.
and let's say you throw going out east, and it might be Mitcham, it might be Ringwood, it might be...
Well, it won't for that price point. It'll be a lot further. That is our challenge with the East.
But, also we're talking that townhouses, could actually be a reasonable option for him as well. But irrespective, what would you weigh up in terms of and consider between those locations? Or if he was going east, what would you be looking at?
I got a few ideas. I was going to finish with my tips and a couple of suggestions for Matthew to run the ruler over. I do love his house idea. I have to confess, and I think he needs to get something that's rent ready. Victoria's got very tight rental legislation and minimum standards, so he needs to be all over that. You don't want to pay a premium for something with a circa 2024 renovation, though. You want to get something that's great that, potentially down the track he might want to put in a new kitchen or add some value, but let's just get a good asset that gets a great tenant. I would certainly consider looking northeast. You could move out towards Watsonia and have a look around there if you're looking for a house. I do like his idea of going down towards Chelsea. You might need to go a tad further. I would stick to train line serviced areas. 1.2 could get him a lot closer to the CBD if he's willing to have a look west. And he doesn't need to go further than Sunshine. He could even have a look at West Footscray, maybe Altona. With the little cottage idea, I love that idea. It's one of my favourite products. And to your question, Mike, your demographic are couples wanting to get into that period house inner city market. So if we're circling in a ring with 1.2 and we're happy with a 2-bedroom cottage, I would actually swing around to the west and look at the inner west. And I live here, I work here, I love it. And I'm not biased when I say this because you've got a greater abundance of properties in that price point from Williamstown up to Footscray than what you do in the north when you're talking about the same distance from town. I do want to throw something out there though. With 1.2 and a freestanding house, I would absolutely have a look at the best pockets of Geelong.
Ooh.
You'll get an inner ring, inner city, period style, renovated. You'll get something very special in Geelong. And there's a lot of data out there on Geelong that he can delve into. Hopefully he has a bit of fun with that. I know it's not a capital city, but I would actually favour that option over a townhouse. But there are other benefits to townhouses, and there's certainly benefits to factoring in the eastern side of Melbourne. We've got some gorgeous suburbs and they're in very high demand, but you would be about 25 to 30 kilometres out if you're looking at a family-style townhouse with a $1.2 million budget.
So if he looks at Geelong, I'm assuming better yields and closer to the centre of town because of the price.
Well, significantly closer,
absolutely. I mean, I've got to ask myself,
1 to 2 k's away.
Would I be more confident about the growth and yield potential of a beautiful renovated period family home in the inner suburbs of Geelong than the equivalent in Melbourne? I think it's worth weighing up. Now, I've got one last bit of homework for Matthew. Pricing analysis is important because if you have a look at what's for sale on a search engine in Melbourne, you'll get a price range, and it's not something to be relied on because, unfortunately, underquoting is rife. So the best thing he can do if he wants to get a bit of a peg in the sand and understand his values from area to area is just look on the sold tab. So, Matthew, I hope that's really helpful for you.
And to all our other listener questions that haven't been asked and some that don't get asked, we thank you very much for sending them all in. And we do have a lot in the backlog, and it does take us a bit of a time to get around to them. So thank you. Keep sending them in. We really appreciate them. And I think pretty much everyone who sends us a question, we do at least respond to you on email with a brief response on some level to your question. Please do send them in. And, you're always free to contact any of our businesses directly if you want to chat about your question as well.
Well, on that note, guys, I'll see you same bat time, same bat channel next week.
See you next week.
See you next week.